3 weeks ago, Jefferies reported the best investment banking quarter in its history. Advisory revenue set a record. Equities trading set a record. Earnings per share more than doubled. And the stock fell anyway. Today it trades about 21% below its 52-week high, at barely more than book value. This is the story of Wall Street's best quarter that nobody wanted, and what the market thinks it knows. Start with the quarter. Total net revenues came in at $2.21 billion, up 35% from a year ago. The mix tells you where the momentum is. Advisory brought in $674 million. Equity underwriting, $371 million. Equities trading printed a record $601 million. Fixed income added $199 million, and asset management $188 million. Nearly every engine of this firm was accelerating at once, with one important exception we'll get to. Zoom in on investment banking. Net revenues hit $1.21 billion, up 57% from the prior year quarter, and combined advisory and underwriting revenue was the best in Jefferies' history. Management stressed that no single outsized fee drove the result. This was breadth. Healthcare, industrials, and energy corporates layered on top of the firm's traditional private equity sponsor base. And the first half was the best on record too, at $2.2 billion, up 47%. All of that fell to the bottom line. Diluted earnings per share came in at $1.02, up 155% from 40 cents a year ago, and return on adjusted tangible equity reached 12.8%, from a firm that earned just 5.5% a year earlier. Step back, and the cycle is obvious. Net revenues fell from $8 billion in fiscal 2021 to $4.7 billion at the trough in fiscal 2023, then recovered to $7.3 billion in fiscal 2025. The first half of fiscal 2026 alone brought in $4.2 billion. Jefferies kept hiring bankers straight through the downturn, and that investment is converting into market share right as the deal window reopens. Here's the stat that tells you what kind of trading firm this is. 63 trading days in the quarter, 0 loss days. A year ago, there were 13, and average value at risk was just $10.3 million. Growing trading revenue with fewer loss days is the signature of a client flow business, not a casino. So why did the stock fall? Asset management. Fees and investment return revenues dropped 35% to $46 million. The 6-month numbers absorbed a goodwill write-down on Tesselis, the Italian telecom now held for sale, and a mark-to-market loss on Market Financial Solutions. And hanging over all of it, press reports put the Point Bonita Fund's exposure to the bankrupt First Brands Group near $715 million, and the SEC is reportedly examining whether fund investors were adequately informed. There are no findings of wrongdoing, but the market is charging for the uncertainty. The balance sheet grew with the franchise. Total assets reached $79.5 billion, up from $67.3 billion a year ago, mostly client balances in prime brokerage. Leverage rose to 7.5 times. Book value stands at $51.95 per share, and adjusted tangible book value at $34.55. Keep those two numbers in mind. They're the anchor for what comes next. At $55.89, Jefferies trades at barely 1.1 times book and about 13 times forward earnings. Run the scenarios. In our base case, the backlog converts and returns hold near 13%. Implied value lands around $62 to $66. In the bull case, an M&A supercycle re-rates the stock towards $75 to $82. In the bear case, the deal window stalls and the fund litigation bites, and it's worth closer to $42 to $45. Today's price gives the firm full credit for the first half, and nothing more. To be clear, that is implied value under stated assumptions, not a price target. Meanwhile, management keeps buying. 7 million shares repurchased in the first half for $372 million, at an average price of $53.42, below where the stock trades today. The dividend is 40 cents a quarter, about a 2.9% yield, and the board refreshed the buyback authorization to $250 million. The bottom line, Jefferies just proved the bull thesis. Record advisory, record equities, a 12.8% return on tangible equity, and got cheaper on the news, Watch 4 things from here: whether the second half backlog converts, the Hildene deal closing this quarter, the Tesselli's sale finishing the merchant banking cleanup, and any resolution of the Point Bonita matter. If the records repeat while the cloud lifts, the re-rating math is simple. If the cycle stalls first, the discount was the market being right. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.